This meeting is being recorded.
Hello, everyone. My name is Jeremy Grant. I'm a partner in capital markets and finance at Stephenson Harwood. A number of you on this webinar will have come across me already, so welcome to you all. We're going to be talking today about transition from LIBOR to risk-free reference rates. We're really pleased that we've got a very big audience on this webinar today. And one of the results of the pandemic is that whereas we can't come and see you personally at the moment, it's given rise to this type of event where we're able to really have some global participation. And I know that we've got participants from all over Europe, the CIS, Central Asia, Asia and Africa on this webinar, and apologies if I missed anyone. So thank you all for joining. The LIBOR transition to risk-free rates is really a burning topic at the moment, and it's becoming more and more urgent as the transition needs to take place at the end of this year or the beginning of next year. And it's very important for borrowers in particular to understand what's going on and to be in a position to engage sensibly, both with counterparties and internally, to make sure that the transition process is smooth. And it's really a revolutionary thing in both the loan market and the bond market, as we'll be hearing. So I'm pleased you could all join. Let me introduce my co-speakers today. So we've got Bertie Chilton. I think a number of you, especially those based in the CIS, will have come across Bertie already. Bertie is a senior associate based in Stephenson Harwood's London office and specialising in banking and finance. And we also have Charlotte Drake, who is a professional support lawyer, also based in London. Charlotte is our go-to person in the firm for LIBOR transition-related questions. She spends a large part of her week, probably more than she'd want, thinking about this type of question. So today we're aiming to speak for around 45 minutes. Charlotte will start and talk about the transition from LIBOR to risk-free rates as an introduction as to what's going on and why it's happening. And then Bertie will go on to cover some of the more technical issues that the implementation of the transition has given rise to, and that may be pertinent to you as borrowers and bond issuers. And then I'll finish off, and that will be mainly focused on the loan market. I'll finish off by talking a bit about the bond market and effect that the LIBOR disappearance is having on the bond market. And we'll go on to some conclusions about points that borrowers need to think about and bear in mind to properly engage internally and externally. The policy as regards questions, we'll try and get to questions at the end if we have time. We won't be doing oral questions, but if you have questions, feel free during the presentation to put them in the chat box, and we'll try and deal with them at the end. If we don't get to them, you'll have our contact details at the end, and we'll have the questions, so we'll try and get back to you in writing. Okay, so over to Charlotte. Thanks.
Thanks very much, Jeremy. If it would be possible, please, to put up the slides at the part 1, that would be great. Thank you. Fantastic. So Jeremy's already described what we'll be covering today. If we could go to the next slide, please, Anisha. Lovely, thank you. In this section of the talk, I'm really going to be addressing how we got to where we are with LIBOR transition and really where we're headed. How we got to where we are, well, back in July 2017, the Financial Conduct Authority, which is the regulator for firms and markets in the UK and which has been the regulator for LIBOR since 2013, announced that current panel banks would no longer be compelled to submit the rates that are required to calculate LIBOR beyond the end of 2021. Now, the current market expectation is, therefore, that either LIBOR is going to cease to exist after the end of 2021, or if it does continue to exist, it will no longer pass regulatory tests of representativeness. Now, I don't think anyone can be under any illusions about the scale of the task that is going to be involved in transitioning away from LIBOR to new rates. It's been described as a complex a task as any faced by the financial sector over the last decade, and it was estimated back in November 2018 that LIBOR underpinned around $300 trillion worth of financial contracts. So I think it's fair to say that discontinuation of a benchmark rate as important as LIBOR will be a fundamental change, and its effects are going to be felt across a broad spectrum of financial markets and products. Now, today we're going to be talking about the transition away from LIBOR, but it is worth also making the point that in parallel across the globe, there is work underway looking at how it's possible to reform other benchmark rates too. But first, let's take a step back and remind ourselves about what LIBOR is and how it works. If I could have the next slide, please. Well, what is LIBOR? LIBOR is an abbreviation for the London Interbank Offered Rate, and it's meant to be a measure of the average rate at which internationally active banks with access to the wholesale unsecured funding market can fund themselves in that market in particular currencies and for particular periods. LIBOR is currently calculated for 5 currencies: US dollar, sterling, euro, Swiss francs, and Japanese yen. It's also calculated currently for 7 terms, sometimes known as tenors, in respect of each currency. And those are overnight, 1 week, 1 month, 2 months, 3 months, 6 months, and 12 months. So this in effect means that on every London business day, there are 35 individual LIBOR rates published. Each LIBOR calculation for the rate is based on data that's contributed by a panel of banks. There are usually between 11 and 16 contributor banks for each of the 5 LIBOR currencies. And the LIBOR rate that eventually ends up being published to the market is a trimmed arithmetic mean of the contributed rates, rounded to 5 decimal places. In effect, that means you take all the rates, you chop off a few at the top, you chop off a few at the bottom, and then you average out the remaining ones and round it up. So that's how LIBOR works. But what's wrong with it? And why are the regulators encouraging the markets to abandon it? Could I have the next slide, please? Well, during the 2008 global financial crisis, concerns arose that interbank benchmark rates such as LIBOR were being manipulated, which led to much greater scrutiny of those rates. And a review in the UK in 2012 resulted in a number of changes to LIBOR to make it much more robust and transparent. The administrator was changed, the code of conduct for contributor banks was made much more tight and firm, and there was a reduction in the number of LIBOR currencies and quoted terms. And in parallel, bodies internationally, such as the Financial Stability Board, were also, thanks to the issues that had arisen during the global financial crisis, been looking at ways at how other benchmark rates more generally could be strengthened. And in 2014, a report was issued which concluded that the focus had to be on reforming and strengthening benchmark rates by anchoring them much more firmly in transaction data. The key problem with LIBOR, so far as regulators is concerned, is that most LIBOR rates contributed by the panel banks are based on judgments of those panel banks making this LIBOR submissions. And that's because the unsecured wholesale bank borrowing market has largely ceased to exist. So LIBOR really has increasingly become a rate which reflects major banks' judgments concerning their cost of borrowing rather than market transactions representing their actual cost of money of borrowing. So despite the efforts to actually improve LIBOR over the last decade, the Financial Conduct Authority, which regulates LIBOR, has made it clear it's potentially unsustainable and undesirable for market participants to continue using this rate, which has no active market underlying it. So what's due to replace LIBOR, and how is it being approached for the various LIBOR currencies? Could I have the next slide, please? In most instances, the alternative that's been identified to replace LIBOR will be called, is a so-called risk-free rate. And that's sometimes abbreviated, or you'll see it written down as RFR. Or it may be a rate that is derived from a risk-free rate. We'll come on to talk more about that in the context of loan agreements. Now, some risk-free rates, such as SONIA, which has been identified as the rate to replace sterling LIBOR, are well-established rates that have recently been reformed to make them more robust. But other risk-free rates, such as SOFR, which has been identified as the rate to replace US dollar LIBOR, are new rates. And what these risk-free rates have in common is they are all backward-looking overnight rates on a pool of virtually risk-free investments. Now, I've set out on the slide the risk-free rates that have been identified for the various LIBOR currencies, as well as the national working groups who are looking at LIBOR transition and the administrators of those new risk-free rates. Could I have the next slide, please? Now, there are several key structural differences between a risk-free rate and LIBOR, and I've summarized some of the main differences on this slide. Now, Bertie will come on to talk about some of these key differences in much more detail in the context of loan agreements. But what I guess the main point to note is that a loan referencing LIBOR and a loan referencing a risk-free rate work in very different ways. Crucially, LIBOR is a forward-looking term rate. So a borrower under a loan agreement, which references LIBOR, can select a 3-month interest period and will have certainty over the LIBOR rate, which will apply to that 3-month period. However, risk-free rates are backwards-looking overnight rates. And Bertie will talk more about how a loan linked to a risk-free rate can give borrower sufficient notice of the amount of interest it will need to pay, given that it's an overnight backwards-looking rate. There are also economic differences between LIBOR and a risk-free rate. At its absolute simplest, LIBOR tends to be a higher rate than the equivalent risk-free rate. And that is because LIBOR has built into it a credit premium, so it takes into account the risk of lending to another bank on an unsecured basis, and also a liquidity premium, which takes account of the risk of lending for a term. However, risk-free rates are firmly anchored in actual transaction data, so they're nearly risk-free, and there's no need to build in credit and liquidity premiums. And that means there's an economic difference between the two rates if you come to transition away from LIBOR to a new risk-free rate. And Bertie's going to talk much more about how lenders are going to look to achieve getting the economic position the same following a transition away from LIBOR in his section of the talk. And finally, there are going to be some administrative differences between these two rates. So LIBOR is currently administered centrally by ICE Benchmark Administration Limited, who publishes LIBOR rates at 11 o'clock London time for all the LIBOR currencies and all the tenors or terms. But risk-free rates are administered by different local administrators and are going to be published at slightly different times. Now, the fundamental differences in the way that which LIBOR and the risk-free rates work is very important, because a loan linked to a risk-free rate will effectively be a very different product to one which is linked to LIBOR, which leads to lots of challenges when you come to transition. If we could move to the next slide, please. Another complication with a LIBOR transition is that it is a complex picture involving a number of different jurisdictions and their central banks or regulators. As I've already mentioned, LIBOR is currently calculated for 5 currencies and generally work in connection with transitioning from LIBOR to a new risk-free rate has been undertaken by a working group, and those working groups tend to operate in the currency's home jurisdiction. So, for example, the US Alternative Reference Rate Committee has been working on LIBOR transition in the US, and there's a sterling working group which has been working on LIBOR transition in the UK. But as LIBOR transitions being dealt with on a currency by currency basis, this has led to some divergences in approach. And we'll come on to see in the next 2 slides that the timing milestones for transition set by the various working groups are not always the same. Now, whether or not this divergence of approach will actually matter in any particular case is likely to depend on, firstly, what regulatory regime may apply to a lender in connection with the making available of the relevant facility, and secondly, whether the regulators in the relevant jurisdiction will actually take account of any failure to follow the recommendations of those working parties. And obviously, for an existing facility, these could well be issues over which a borrower could have very little control. It's worth noting that the working groups themselves don't have regulatory powers, but the recommendations that they make in relation to LIBOR transition are expected to guide the market. And that's because certain national regulators have expressed support for the recommendations of the working groups in their jurisdiction, which obviously gives them more relevance. Now, finally, while I expect a number of you will be concerned with US dollar denominated financial products rather than sterling, it is worth noting that the recommendations of the sterling working group are likely to be relevant. And that's because the Loan Market Association, whose recommended forms of agreement underpin so many hundreds of international facilities worldwide, has been using the recommendations of the Sterling Working Group to inform the drafting of its exposure draft loan agreements, and will, going forward, use the recommendations of the Sterling Working Group to publish its recommended forms. And that's the case whether or not a loan references sterling LIBOR or another LIBOR currency. Could I have the next slide, please? Now, the different currency working groups looking at LIBOR transition have set different timing milestones for lenders to try and achieve movement away from LIBOR to these new risk-free rates. And I thought it would probably be useful to look first at the sterling working group milestones, and then to have a look at the milestones that have been set by the ARRC or ARC in the US. And these seem to me to be the most relevant. First, because the sterling working group's recommendations are influencing the drafting of LMA loan agreements, regardless of the currency of the loan, while the recommendations of ARC in the US might be relevant to certain lenders who make available US dollar loans. It's also worth noting that in the last month, the Financial Stability Board have also issued their own so-called roadmap for transition. But I'm not going to go into that in very much detail, because very broadly, the milestones that they have referenced are in line really with the Sterling Working Group and ARC. So first, let's look at the Sterling Working Group's transition milestones, because these are what's influencing what the Loan Market Association has been doing. Now, the first important milestone was the 30th of September 2020. And by that date, UK lenders are expected to be in a position, or were expected, and now are expected, to be in a position to offer non-LIBOR linked products to their customers. Also, after the 30th of September, lenders need to include clear contractual arrangements in all new and amended LIBOR referencing loan products to facilitate conversion to another rate, such as a risk-free rate. And the Sterling Working Group has said that this can be done either by including in the loan agreement what's called pre-agreed conversion terms, or an agreed process for renegotiation. Pre-agreed conversion terms would be some kind of hardwired switch mechanism. So on a predetermined date, the interest rate flips from LIBOR to the new rate without further agreement being needed. And an agreed process for renegotiation would be a clause such as the replacement of screen rate clause, which sets out a mechanism under which the parties agree at a future date on a replacement benchmark rate and the changes that will be required when that change happens. The next milestone is the 31st of March 2021, and after that date, a lender shouldn't be issuing any new loans which reference LIBOR. And they're expected then to continue work on transitioning their legacy loan book away from LIBOR during Q2 and Q3 2021. And then the final really big date, and I've kind of shown that as more of a wall than a line in the sand on the slides, is the 31st of December 2021. And this is the date on which, for all intents and purposes, the Financial Conduct Authority wants everybody not to be on LIBOR any longer. Could I have the next slide, please? Now, in the US, the Alternative Reference Rate Committee, or ARC, has been looking at transition away from US dollar LIBOR and has settled on SOFR, the Secured Overnight Financing Rate, as the replacement benchmark. And this slide shows the milestones that have been set by ARC for US loans, or US dollars transition from LIBOR. You can see that the 30th of September was also a milestone for US loans, but ARC went a little bit further than the Sterling Working Group. And they say the only recommended approach for documenting new loans is for them to insert a pre-agreed conversion terms. So that means that some kind of hardwired rate switch mechanism should be embedded in the loan agreement. Unlike the Sterling Working Group, ARC have not recommended use of a pre-agreed process for negotiation. So that means a clause, something like the replacement of screen rate clause, or a clause whereby the parties agree at a future date to agree the changes necessary to transition. The next milestone is actually later than the one in the UK, so it's 30th of June 2021 compared to the 31st of March 2021, and by that date, all new loans need to reference the new rate only, with no mention of LIBOR. And any existing loan maturing after the 31st of December 2021 and which has tranches that still need to be advanced will need to be amended. And then again, during Q3 and Q4 of 2021, existing loans maturing after 2021, the end of 2021, also need to be amended. I'm now going to hand over to Bertie, who will describe in more detail how transition away from LIBOR to the new rates will specifically impact on the loans market, and in particular issues that borrowers will want to consider.
Thank you, Charlotte. Anisha, yeah, thanks. Can we move on to the next slide? As mentioned previously, I'm now going to cover some of the issues regarding the adoption of risk-free rates and the transition away from the use of LIBOR that may be of interest to borrowers in the loan market. I should stress that this will be a high-level review of specific issues and not a comprehensive examination of all the recommendations of the Sterling Working Group, ARC, or other applicable regulatory bodies or working groups. Anisha, can we move on to the next slide, please? It goes without saying that the transition will have a significant impact on how interest is calculated under floating rate loan documentation that currently or that would otherwise have referenced LIBOR. This essentially stems from the fact that LIBOR and the risk-free rates are fundamentally different economic measurements. As Charlotte's already set out, LIBOR provides for forward-looking term rates, and the replacement risk-free rates are all backward-looking overnight rates. Interest under loan agreements is calculated over a defined period, normally consisting of a number of months, although it can be whatever the parties agree. LIBOR generally provides for term rates equivalent to these periods. Risk-free rates are daily rates. Therefore, to calculate a single rate which can apply to a loan during the whole interest period, it is going to be necessary to take an average of the relevant daily rates applicable during the course of that interest period. There's been a lot of discussion in the various working groups as to how these averages should be calculated, and there are a range of recommendations from the working groups. We aren't going to go into detail with respect to all of these, as in most cases your creditors will have decided what assumptions and recommendations they will use. The one area, however, where as borrowers you will see this impact is the notice you get of the amount of interest due at the end of an interest period. Currently, the applicable LIBOR for an interest period will be known to the parties at the beginning of that interest period, which then allows the borrower to know at that time the exact amount of interest they will owe at the end of that period. Anisha, can we move on to the next slide, please? With the use of risk-free rates, this will not be possible because the rate for an interest period will be the average of the daily rates for that period, and therefore the average rate will only be known at the end of the interest period. This is likely to be unworkable, as it will not allow borrowers enough time to make their interest payments on the last day of the interest period. It poses an even larger problem in syndicated facilities, as time is needed for the agent to calculate the interest, notify the parties, collect it, and then redistribute it. To tackle this issue, the various working groups have recommended, and so far the market has adopted, two conventions that both shift the calculation period back by a set number of days. Current market trends and the working group recommendations suggest that this is likely to be 5 business days. These conventions are being referred to as look-back. Again, I don't propose going into the detail of the differences in the look-back conventions here, although I have on the next slide added a diagram that the Sterling Working Group published in a paper this September, and that demonstrates the differences between the two conventions. What this does mean in practice, though, is that firstly, there will technically be a mismatch between the actual interest period and the calculation period for the rate. And secondly, rather than knowing at the beginning of an interest period the amount of interest that you will have to pay, you will only know 5 business days prior to the end of that interest period. Some borrowers in certain jurisdictions will also have to carefully consider at the time they are negotiating these provisions whether this will give them sufficient time to deal with any currency control or similar restrictions affecting their interest payments. Anisha, can I move on to the next slide, please? As mentioned, for those who are interested, this is the diagram from the Sterling Working Group demonstrating how the look-back conventions would work. If anyone has any questions on this, please feel free to raise them at the end or using the chat function, and we will try and address them to the best of our abilities. Anisha, can we move on to the next slide, please? Another issue that you should be aware of when negotiating loan documentation using risk-free rates is the application of credit adjustment spreads to the risk-free rate. As Charlotte has also mentioned, LIBOR rates have built into them liquidity and credit premiums, as they take into account the risk of lending to another bank on an unsecured basis and the risk of lending over a term. Risk-free rates are conversely nearly risk-free, hence the name. In practical terms, this will mean that in general, LIBOR rates will be higher than a replacement risk-free rate and will therefore produce a pricing gap for lenders. Where new loans are being documented with transitional arrangements to switch from LIBOR to risk-free rates, or where you negotiate standalone amendments to existing loan agreements to effect the transition, lenders will want to include a credit adjustment spread over the applicable risk-free rate in order to maintain the same economic result. Again, the exact methodology has been subject to a lot of discussion in the various working groups, but most now have settled on recommending some form of average historical spread adjustment between LIBOR and the applicable risk-free rate. Where this will be an issue for you, however, is negotiating floating rate loan agreements that use risk-free rates from day one. Arguably, these sort of loan agreements will not need any credit adjustment spread, and lenders should be able to calculate their required returns using just the risk-free rate and a margin. This does not mean that some lenders may not suggest using credit adjustment spreads in such documentation. For example, the Loan Market Association has published exposure drafts of facility agreements with rate switch provisions that include credit adjustment spreads. If lenders use these drafts as the basis for their precedent documentation, they may end up trying to include credit adjustment spreads even in day one risk-free loans. Anisha, could we move on to the next slide, please? Similarly, going forward, you want to be wary of the use of break cost clauses and market disruption clauses. Typically, loan agreements contain break clauses that protect lenders where they have match funding for a loan or an interest period. Theoretically, the reason why LIBOR was used previously as a benchmark rate was because lenders were borrowing from the interbank markets to lend loans for matching terms. If a loan was repaid prior to the end of an agreed term, then there could be a mismatch between what the lender receives from the borrower and what it owed in the interbank market. Arguably, for the reasons Charlotte highlighted at the beginning of her section, this has not been the reality of the funding process for some time. However, break cost clauses have prevailed in the market. Where you transition an existing deal from LIBOR to risk-free rates, or are agreeing a risk-free rate-based loan agreement, it's less clear that break costs will apply, as there's no longer a link between the interest rate in the loan itself, and the lender's matching interbank funding. You may see lenders quantifying break costs in another manner, however. For example, break costs arising on breaking interest rate swaps, or break costs which have the de facto effect of protecting other interests. That said, it's probably fair to resist the inclusion of break cost clauses in their current formulation in any day one risk-free rate loan agreements. Similarly, market disruption clauses deal with the situation where the interest rate a lender receives is no longer representative of its cost of funding. Again, as the use of risk-free rates would imply no such direct link to the bank's cost of funding, it's arguable that the market disruptions should still apply to risk-free rate referencing facility agreements. Anisha, could I move on to the next slide, please? Another issue to be aware of is the interaction of hedging arrangements with any transitional or risk-free rate-based loan agreements. As LIBOR is a floating rate of interest, it's common for borrowers to hedge their exposure to rate increases by using an interest rate swap or cap. It's important to note also that such hedging arrangements are typically entirely separate contractual arrangements between the borrower and a hedge counterparty. The vast majority of interest rate hedging is undertaken using ISDA documentation. ISDA have, like the LMA and other market participants, been actively engaged in LIBOR discontinuation and the transition to risk-free rates. They have published supplemental documents setting out a waterfall of fallback rates to be used where LIBOR ceases to be published, or it's clear that LIBOR is no longer accepted by regulators and/or the market as a suitable benchmark rate. Existing hedging arrangements can incorporate these new fallback rates by either bilateral amendments or the hedge counterparties signing up to an agreed protocol. You should be aware, however, that the waterfall of fallback rates recommended by ISDA are not identical to the recommendations of the Sterling Working Group, ARC, and other working groups. There is therefore a strong possibility that when existing hedging deals transition to risk-free rates, there may be an economic mismatch between the interest payable under the loan documents and the floating payments received by the borrower under the hedging arrangements. We are yet to see a lot of examples about how the market will deal with this in practice. One suggestion is that it might be easier to close out your existing hedging arrangements when the loan documentation transitions and enter into a new arrangement where you can ensure the payments match. I should add here that interest rate hedging makes up a very small part of the derivatives that ISDA deals with, and therefore ensuring that the documentation works with the transition in the loan market is fairly low on their list of priorities. Other solutions may therefore be worked out, but they may take some time to be adopted. Anisha, can we move into the next slide, please? There are a few other issues that I'll touch on briefly, the first being the use of Euribor. Charlotte mentioned that the future risk-free rate for euros is likely to be what's being referred to as ESTA. However, those of you who borrow in euros may already be aware that the methodology for calculating Euribor, the European Central Bank's equivalent to LIBOR, was reformed over the course of 2018 and 2019 to firstly bring it in line with the EU benchmark regulation, and secondly, and probably more importantly, in theory, makes it suitable for continual use. So far, this appears to have been accepted by the market. For example, the multi-currency version of the Loan Market Association's exposure drafts continues to reference Euribor for euro loans. Its long-term survival, however, is not guaranteed, as it will rely on a panel of banks to provide submissions. And further, the ECB this summer launched a consultation process on the use of compounded term rates based on ESTA. Zero rate floors also pose a potential issue in transitional arrangements. It's been fairly common since the last financial crisis back in 2018 for lenders to insist on zero floors in floating interest rate provisions to protect themselves from negative interest rates. Exactly how these are transposed to risk-free rates have been a topic of discussion within the various working groups. I don't propose to go into detail of the various different conventions that have been suggested or recommended here, as firstly, the issues are quite technical, and secondly, in many instances, the resulting calculations won't produce significantly different results. We do suggest, however, you discuss this, how this is being dealt with your advisors to avoid any unintentional consequences as you transition your existing deals to risk-free rates. You may also be aware of discussions about the use of synthetic LIBOR rates for difficult legacy contracts, and also the development and use of forward-looking term rates. Working groups and regulators are looking at the possibility of maintaining some form of synthetic LIBOR for use post the end of 2021 in what are being referred to as tough legacy contracts. These would be contracts where, for specific practical reasons, the use of an overnight rate-based risk-free rate won't work. Legislation has been put in place in both England and New York to allow regulators to maintain and publish such a synthetic rate, but we still don't have any clarity on their formulations or to which legacy contracts they will apply. Equally, it's not clear to what extent a rate published by a regulator in England or the US will apply to contracting parties if their only connection to those jurisdictions is the governing law of their debt documentation. Also, in the US and the UK, beta forward looking term rates are currently being tested, which might ultimately provide LIBOR replacements for such tough legacy contracts. However, while work is ongoing, we currently don't know yet whether these term rates will pass regulatory scrutiny in relevant jurisdictions or exactly when they will become available. COVID-19 also will likely delay this process further, as some have questioned the ability of regulators to test such rates during a period of economic stress. It's important to note, though, the use of both synthetic LIBOR and new forward-looking rates should not be thought of as a substitution for consensual transition arrangements. All the working groups and regulators so far have made that clear. Anisha, could we move on to the next slide, please? So what should you practically be doing at this stage? Well, the short, slightly unhelpful answer is it depends, and that's largely on the recommendations and targets set out by the relevant regulatory bodies or working groups applicable to you, and probably more likely your creditors. As Charlotte mentioned, we're moving from a situation where we rely on a single set of rates and conventions used to calculate them, as well as a single administrator, to an environment where rates for each currency will be subject to a separate regulation and administration, and also where for the foreseeable future, the conventions will be based on a range of recommendations rather than be set in stone. It will not always be obvious, therefore, what recommendations and conventions will be correct for your deal. For example, just because you are borrowing in dollars does not necessarily mean that your lenders will insist on following the ARC recommendations, especially if they're not a US bank. Similarly, you may see in a syndicated or club deals disagreements between the lenders as to which recommendations to follow. It's therefore worth considering how, as borrowers, you are going to approach the topic of transitioning to risk-free rates with your existing lenders. It's worth being mindful that under most loan documentation, as they are drafted today, if LIBOR were to cease to be published, your interest payments would ultimately be calculated based on the lender's cost of funds. I'm sure we can all agree that this would not be an acceptable outcome for borrowers. It therefore may be prudent for you to approach your existing lenders to begin discussing the transition well ahead of LIBOR being discontinued. In fact, depending on the jurisdictions you're based in, a regulatory body may have already made contact with you to suggest doing so. Sorry, skip my slides. When should you be doing this? As Charlotte mentioned, the broad consensus is that LIBOR will be discontinued by the end of 2021, or at least will no longer be an appropriate benchmark by that date. In addition, the Sterling Working Group and ARC have set recommended deadlines of the 31st of March 2021 and the 30th of June 2021, respectively, for when lenders should cease to provide LIBOR-linked loans with maturities past the end of 2021. The Financial Stability Board has also suggested in its Global Transition Roadmap, published last month, that creditors by mid-2021 formalise plans to amend legacy contracts where this can be done and have implemented the necessary system and process changes to enable transition to robust alternative rates. It therefore seems likely that in Q2 and Q3 of next year, most lenders should be ready to at least start discussing the transition. This approach would also provide you with plenty of time before the hard deadlines at the end of the year. Do, however, be mindful of the cost indemnities in your loan documentation when approaching your lenders. Most loan documents require the borrowers to indemnify lenders for the cost of documenting any changes the borrower requests. If you are instigating the transition discussions, it would therefore be worthwhile explicitly discussing who will cover the costs of documenting the necessary amendments. Otherwise, your lender may up insisting on the indemnities being applied. Similarly, if the transition is being implemented as part of a wider restructuring or refinancing of existing loan facilities, you may be in a position to discuss sharing the costs for at least the transition elements. I hope that's been useful. As I mentioned, it's a slightly whistle-stop tour through some of the issues that we thought were more pertinent for borrowers. If you do have any further questions, please do get in touch. I'm now going to pass on to Jeremy to discuss the impact of the impact in the bond market.
Thanks, Bertie. Next slide, please. Thank you. So the good news on bonds is that the audience on this webinar is likely to have fixed rate bonds rather than floating rate bonds. I mean, you may have come across floating rate bonds in the context of things like project financings, and if you're a bank, banks often issue floating rate notes, obviously, but I think the majority of the bond market, and certainly the Eurobond market, is a fixed rate market. So the LIBOR transition per se is not so relevant. Why is it a fixed rate market? Because investors are paying out of their own pockets, are investing in a company, and the company is able to place bonds with them over a period at a fixed rate, a relatively long period, 3 to 5 years usually, at a fixed rate. Whereas as you know, in the loan market, it's a question of banks borrowing money from other banks and lending it on to borrowers with a margin. So it's a different type of market, and the Eurobond market is traditionally fixed rate, so less concerns perhaps about LIBOR change. However, where we do have to tackle LIBOR, there are some difficulties in the bond market which are not there in the loan market, and in particular, borrowers, issuers are dealing with a moving pool of bondholders. So bondholders are transferring, trading their bonds every day. We don't necessarily know who's holding the bond at any one time. We don't have an agent bank that we can conveniently negotiate with and agree the LIBOR transition process. It will be up to the issuer to instigate any changes that need to happen. And usually this will need to be done by way of a consent solicitation. You'll need to go out to the bondholders, request a bondholder meeting, put the proposed changes to them, and get them to agree to them. So slightly more difficult to amend bonds than loans. But having said all that, the default position for bonds is usually more issuer-friendly than loans. As Bertie just said, if everything goes wrong in a loan and there's no rate left to quote, you go back to a cost of funds concept, which is potentially expensive and not what anyone really wants. However, in floating rate bonds, the usual way to do it is if LIBOR is not available when you're trying to calculate it, you go back to the last date when it was available and calculate it based on that. and the bond effectively turns into a fixed rate bond. So a different way of dealing with LIBOR disappearance in bonds compared to loans. Next slide, please. So let's just quickly look, and I'm not going to speak for very long at all, but how the bond market is dealing with LIBOR transition. So we've got three different categories here. We've got your old floating rate deals, your old FRNs, usually issued before 2017 and before anyone was worried or knew about what was going on with LIBOR transition. There, obviously, there are no switch mechanics to switch from LIBOR to risk-free rates, and an issuer would have to go and do a consent solicitation if that bond is going to have a long maturity going past 2021. Consent solicitation whereby they would put the terms that they wanted to the note holders, and non-note holders would have to go and vote at a meeting in order to get them changed. And obviously, as part of those terms, the issuer would be suggesting how the interest calculation mechanics would be changing to take account of all the good stuff that Bertie just said about the different way that the interest will be calculated, but also, importantly, to take account of the spread adjustment. So building in that credit and term spread to turn it from a LIBOR rate to an RFR. And usually the way that that's been done in the bond consent solicitations that we've seen is to do a kind of interpolation between a historical LIBOR swap rate and a risk-free rate swap rate to get a fair measure of what margin needs to be added on to turn one into the other. More recent deals, i.e. deals generally that have happened since 2017, when all this kicked off, and also MTN programs, so multiple issuance programs which have to deal with a variety of different IBORs in different currencies. What we're seeing there in order to deal with this is to have an agent bank appointed, so a bank which will act a little bit like the facility agent in a loan agreement. And as soon as a benchmark event happens, so LIBOR disappearing or being about to disappear, or someone announcing that it's no longer usable, the agent bank will be appointed, and then they are given discretion unilaterally to make changes to the bond terms as they see fit in order to turn a LIBOR rate into a risk-free rate. So that will include making changes to the calculation mechanics and the spread. And obviously, we warn investors about that in our bonds and in our programs to tell them, you know, if this benchmark event is going to be happening, and the agent will have full discretion to change the bond terms without having to go to you and get your consent to do it. And then newly issued FRNs. So there we're using risk-free rates from the outset, and there is already a quite developed and large floating rate note market using risk-free rates. What's been happening there in terms of market developments is we've seen a bit of a divergence between the way that sterling bonds are done, and there we have a lag or a look-back approach, a bit like what we have in the LMA loans, where we would calculate the interest and stop 5 days before the interest payment date, so that the borrower, the issuer, knows how much he needs to pay. Whereas the SOFR market and the US market is using a slightly different approach, which is where the interest rate is locked 4 or 5 days before the interest payment date, so it turns into a kind of fixed rate during that 4 or 5 days. Or alternatively, you stop the interest, you stop calculating the interest on the interest payment date, but the borrower, the issuer, doesn't have to pay the interest until a couple of days afterwards, so it has time to know how much it pays and have a couple of days to get the money together. Next slide, please. So that's all I wanted to say about bonds. Just to wrap up then, next slide, please. A few conclusions, drawing a bit on what Bertie said in his conclusions, but what should borrowers be doing now? First of all, identify your outstanding LIBOR and other IBOR exposures. And this is not necessarily just in loan agreements or in bonds. but also things like derivatives contracts that you have, ISDAs, but also perhaps commercial contracts where certain calculations need to be made based on LIBOR. You need to do a diligence internally to see what contracts you have that reference LIBOR and see how to deal with them. You need to understand how risk-free rates work and what changes they will necessitate. And obviously participating in something like this will help, and asking questions afterwards to us, please do, and this will allow you to engage with the issues and understand better how they work. Monitoring market developments, please sign up to our newsletters and our regular updates on how LIBOR works. Have a look at what's going on in the LMA and in the ICMA for bonds to see what the latest developments are there. Engage with your counterparties, some proactive engagement with lenders and with bond trustees, for example, to see how they're planning to deal with LIBOR transition with relation to the agreements that they have with you. Engage internally as well to create a transition plan. It's all very well for the legal department to know that this is going on, but if the people who actually deal with the interest payments and need to be informed of how much interest needs to be paid in a certain number of days before it's paid, if they're not aware of all this, that all this is going on, they need to be told, and understand. You need to understand if your systems need to be updated to take account of that. And even things, as Bertie mentioned, like currency control restrictions, a wider type of due diligence and audit will need to be done to understand how particular borrowers are going to cope and deal with LIBOR transition. Okay, so we've spoken for 50 minutes. I think that's all we wanted to say today. Thank you very much, all of you, for joining, and I hope it's been useful. I want to thank Bertie and Charlotte, and also my partner Ruben Weston, who has helped to spearhead the organisation of this webinar. You have our contact details on the last page of this these slides, which we'll distribute to you all. And so if there are any questions, don't hesitate. We won't be charging you, so please do write to us and ask the questions. This has been obviously by necessity a very brief overview of the issues, but it is a very complicated subject, a very urgent one and a very important one, so please do write to us and engage with us. Thank you very much. Bye-bye.